So, welcome everybody. Thank you for joining me. Glad you took the time out of your busy day to learn about this stuff. Obviously, taxes are a very important thing if you're in real estate or any type of investment, you're a business owner. But knowing how to navigate it the right way, a lot of you guys probably in the last few weeks have gotten your returns back, the preliminary returns, things like that from your CPAs. You're not too happy. So we really want to field a lot of you know, figuring out what we need to do to help some of you guys or your clients, because we're going to talk about how this works for real estate professionals. If you're a real estate broker, real estate agent, and you're in the business of selling real estate, these are going to be, very valuable to your clients and helping you differentiate yourself in the field of real estate. So we'll go ahead and get started. Just to kind of start off, this is the usual compliance. Anything that I kind of go over here today is not tax advice. I am not your CPA. I'm not your attorney. So if you implement anything or try to implement anything after this training, you cannot hold me liable for that. So just kind of keep that in mind. So for those of you guys that don't know me, we got a lot of clients, people I've talked to before. We have CPAs, we have people all over the board on the call today. My name is Stefan Bellholm, a tax strategist. We also have Michelle Nice, who is my partner in crime in life and in business. She's kind of the COO in charge. She's a tax strategist too. And basically what we do is we work with, we have a whole team of forensic CPAs, tax attorneys, specialists, all over the country when it comes to these different strategies and tax structures to help not only real estate investors, but also real estate brokers and also tax firms. We work with a lot of CPAs, do a lot of collaboration with them all over the country and even internationally to help them and their clients use and take advantage of these advanced tax structures and strategies. Because if you know anything about CPAs and accounting, it's very boring. It's very monotonous, and a lot of it is not proactive. We'll kind of go into that later. So we're here to kind of help and supplement. So I really want you guys to understand, we're not trying to take away any type of CPA or accountant relationship that you have. We were really trying to enhance that. This is a team effort. So if you guys choose to work with us or take the next step forward with us after this call, just know that that's kind of our goal, is to work with whoever you have that you're working with now. Now, big thing to understand is there's a difference between tax avoidance and tax evasion. Everything that we do is legal, and it's tax avoidance, which is a legal part. A lot of people don't know that. But tax evasion, hey, when you're misrepresenting things, when you're not reporting things, when you're going against the IRS code, using improper ways of deductions, concealing things, that's illegal. That's gray area. We don't go into that. But when it comes to tax avoidance, which is, again, legal per the IRS. So this is an actual IRS document. It's the IRS handbook for special agents. So when the IRS agents come at your door, this is kind of how they get trained. It says clearly, tax avoidance is not a criminal offense. Any attempt to reduce, avoid, minimize, or alleviate taxes by legitimate means, so that's the key words, is permissible. And so when it comes to all of our strategies or tax structures and stuff like that, that's what we promote, okay? And another thing here, I'm not sure if you guys have ever heard of this quote by Judge Billings Learned Hand, which I think is the coolest name ever. But, he was a Court of Appeals judge, over 100 years ago. And his quote was, "Anyone may arrange his affairs so that his taxes shall be as low as possible. He is not bound to choose that pattern which best pays the treasury. There's not even a patriotic duty to increase one's taxes," which is big. Over and over again, the courts have said that there is nothing sinister in so arranging affairs as to keep taxes as low as possible. Everyone does it, rich and poor alike. They all do it right, for nobody owes any public duty to pay more than the law demands. So I just really want you guys to keep that in perspective when it comes to taxes in this country. A lot of people don't understand, the tax code is complex. They do that obviously intentionally, but if you're doing things the right way, it's very possible to pay as little tax as possible, just like, the wealthy people do. So, and that kind of dovetails into what I was talking about before about the difference between tax prep and tax planning. Most of you guys, if you have, accountants, tax attorneys, CPAs, they're really good at what they do, but most of the work that they do is very reactive. So they're looking at, hey, this is how much, income I took in. This is what your deductions were. We're going to file it, and then we're going to kind of tell you what you owe at the end of the year, which you have to do, right? If you don't do that, you're going to go to jail, and no one here wants to go to jail. But that's not really helping you to reduce your taxes. And the only way that we can do that is by being proactive, by looking at all your stuff beforehand. So, we're going to talk a lot about real estate today. Hey, before you sell that real estate, before you sell that property, what do we need to do to make sure that you're, minimizing or reducing or even eliminating part of that capital gain? We have to be doing that stuff before, not after. And so that's really the difference between what we do and our team and our specialists, attorneys, CPAs all around the country versus, whoever you guys have working with you. And again, the goal is to have a collaborative effort to help you. So, it's not one or the other. You need both. But most CPAs, most people in the tax business focus on this side, on the red side, not the green side. So we're here to have that to complement. So the agenda today really is going to be really simple. We're going to talk about how tax structures work. We're going to do it from a 30,000-foot view, not go too much into the weeds because it can get really in-depth and we don't have that much time, and I don't want to take your guys' time or make you guys fall asleep because taxes, again, are boring. So I don't want, I want this to be very informative and educational for you guys to make the next decision, whether that's working with us or someone else. So we're going to talk about how these tax structures works, alternatives to 1031 exchanges, which is a big deal if you are in the business of selling real estate, again, as a real estate broker. If you have a whole bunch of properties or you have a business, you're trying to sell it, what are some things that you can do to avoid that tax without having to rush into a 1031 exchange? We'll go over some examples and then talk about, again, if you're in the real estate business, you're a real estate agent, a broker, with all this stuff going on with the NAR, you have to find ways to differentiate yourself and stand out from the rest of the industry because things are going to change. So capital gains. Obviously, you guys know that when you have an investment, a property, a business, you bought it for this, you sold it for this much, you're going to pay capital gains tax, right? And capital gains rates have changed a lot over history, and most people don't realize how much they fluctuated. But one of the things to kind of understand, a lot of people don't realize that, is that there's going to be a change with the capital gains rate in some way, shape, or form. It may not be directly how the rate is the exact rate, but how the rate is calculated, because the government actually collected almost $500 billion in capital gains taxes in 2021. And that was almost double what they collected the year prior. And so they're obviously, with real estate, that had a lot to do with it, but the government is looking at ways to, change how they structure capital gains, because people have been, in their minds getting away with murder with these 1031 exchanges and stuff like that. And Biden has already brought up a second addition to kind of thinking of how he wants to change that whole 1031 exchange structure. So who knows what's going to happen? No one has a crystal ball, but the reality is the government has projections of collecting trillions of dollars in capital gains taxes. You can just Google it. It's on the IRS website. So they're figuring out a way and they're going to do it. So you guys have to be proactive, to have a better outcome. And it's not just about capital gains, right? When you're selling an investment, whether it's real estate or a business or anything like that, you have a lot more than just capital gains tax, right? Now you have the net investment tax, the Obamacare tax, that's 3.8%. If you've taken depreciation, so all these people that have done cost segregation studies and this and that, and which is great on the front end, but when you actually sell and you don't do a 1031 exchange or anything like that, you get killed. And we'll go into an example of that. You have state tax, up in California, up to 13.3%. You have mortgage over basis tax, which a lot of people don't talk about. But if you have a property or an investment that has debt, and that debt is more than your basis, that's an extra 40% the government charges on that difference. There's some nuances with that, but there's just all these different taxes. You have mansion tax, in LA, and I think Santa Fe or some other places, they have another tax, local tax. So there's all these different things, and most sellers, whether it's you or whether it's your clients, they don't realize this until they're at the closing table. And so what happens is it's, okay, do I actually want to sell? Because this is how much I'm going to have left after paying the taxes. And oh crap, what do I do? And so that's really what this whole conversation is about, is figuring out what we need to do proactively. Now, traditionally, and I'm going to kind of open it up here, Michelle, and if you guys have any questions, feel free to raise your hand and I'll have Shelly unmute you or whatnot. But traditionally, people have used these types of strategies: depreciation, installment sales, opportunity zones. Does anyone use any of these strategies either for themselves or for clients? Let's kind of open it up right now. Anyone want to unmute themselves or raise their hand or whatnot? Everyone silent? Okay. Well, there are some good things about these things. There are some not so good things about these things. And I can tell you that from a 30,000-foot view, what it all amounts to is you're just kicking the can down the road. Depreciation is great. Installment sales are great. Opportunity zones are great, but you're just kind of kicking the can down the road. You're not really helping to reduce your tax. You're just deferring. Okay. So let's kind of talk about the 1031 exchange a little bit, because that's a very, very popular strategy that people will use with when it comes to real estate. And obviously, the good thing about that is that it helps you defer that capital gain, right? You don't have to worry about paying that capital gain because you're just shifting it over into another real estate investment, right? So you're able to preserve your equity, and if you pass away, your heirs don't have to pay any cap gains on that, right? They get a step up in basis. So that's the benefit of a 1031 exchange. The not so good thing about the 1031 exchange is that it's very complex, right? If any of you guys have not done a 1031 exchange, I can tell you from experience, it's very complex. There's a lot of requirements, deadlines you have to meet. You have to find a property within a certain timeline. You have to close. You know, what type of property could you go into? And you know, it's not really liquid. You know, if you don't want to go into real estate, if you don't want to have to be forced into going into another property when you sell your real estate investments, 1031 exchanges are not the best thing. In addition to that, you can't do a 1031 if you're selling a primary residence, a second home, or if you're doing real estate investment flips. So if you're a person who buys and sells, you know, you can't really 1031. And if you have other assets, and this is one of the things we talk about is, you know, especially if you have clients that have other investments and things of that nature, they can use their crypto or their stocks or whatever to sell that investment and purchase real estate without paying capital gains, but they have to be using these tax structures. So that's something that you can't do within the confines of a 1031 exchange. And obviously, for those of you that may have some experience with 1031s, you know, a lot of 1031s fail. They don't go through, right? And that sucks because then it becomes a taxable event and the client's upset. So this is an article that came out, and I'll be more than happy to send you guys a link to this, but you can just find it, Google it on the NAR website. But it talks about the truth of 1031 exchanges. And I think that this title is probably the best, most appropriate title, because it essentially says most people are going to get taxed with 1031 exchanges. And the whole point of it is, this article it's arguing why the government should keep 1031 exchanges instead of repealing it, because the government actually makes more money by having the 1031 exchange in place from a long-term perspective. So this article is basically echoing what I'm saying right now, which is, if you're doing a lot of the traditional strategies, you're literally just kicking the can down the road. You're not really improving your tax position. You're just deferring or postponing, which is better than nothing. But what are some ways that we can be more creative when it comes to deferring and even reducing capital gains tax? And that's really what we want to talk about today. And it really boils down to learning how to use some of these specialized tax structures. That's really it. You just have to go into a different bucket and into a different arena of doing things than the traditional way of strategy. So, you know, it could be special purpose vehicles, charitable trusts, philanthropic LLCs, holding companies, family trusts. There's so many. These are just a few examples. There's so many different tax structures out there. Is anyone familiar with any of these strategies? Does anyone use any of these strategies? I'm gonna open it up. I'm sick of talking for right now. Anyone? No? Okay. Well, I will keep going on then.
Stefan,
Yes.
can you hear me? This is Michelle.
Yes.
I'm not able to see the attendees raising their hands. I'm not sure if you click you know, the button where I can see to unmute anybody.
Um, okay. Let me see for a second. Okay.
All right,
Sarah,
someone raising their hand now. Okay.
okay. You can unmute her.
I'm clicking on her, but it's not allowing me to unmute.
You should, it should say ask to unmute
I
right
know,
there on the
I,
panelist, on the
I
attendee
know.
side.
Yeah, it should say
Oh, sure. Can you
now.
talk now?
Yeah, there we go.
Hey, can you guys hear me?
Yeah, I can hear you, Sarah.
Okay. I mean, I'm not familiar with these specialized tax structures other than knowing other people who use them. Someone in oil and gas, they have some sort of trust set up. And
Yeah,
then I've also heard of the LLC with the limited partnership. But my question was about the 1031 exchanges. They're kind of pointing out what I found wrong with that is that it has to be like kind. So I've invested for 12 years. I'm not always going to want to sell, a single family home and buy another one. Like in this
exactly.
case, I just sold an Airbnb and now I'm going to want to build something else. But a 1031 exchange won't work for that.
Exactly.
So,
Exactly.
yeah.
And there's some nuances with the whole like kind thing. That's the other thing. Because there's technically, I mean, you could go from like an office building to industrial. So I mean, essentially the 1031 has to be for business or investment use. But again, it just points back to the whole nuances and, oh, okay, you have to be doing things in such a way for the 1031 to work, to be in compliance with it. So yeah, I hear you.
Yeah, thus far I've just, done the whole fix up 2-year primary residence or, pay the 20%
Hmm.
capital gain tax on the sale. So I'm just looking for a different way to kind of
Exactly.
structure my business.
100%. Yeah. So we'll go over a lot of strategies right actually right now. So cool. All
All
right.
right,
Awesome.
great.
All right, cool. All right, so we'll go ahead and Shelly, let me just make sure that I think what it is you're actually logged in twice. That's what it is. You're logged in twice. I don't know why.
I think it's okay now because I can
Okay.
see if they raise their hand and I can unmute them now. So
Okay.
however we have it,
All right.
let's just leave it.
Cool. All right. Yay. All the technical issues are gone, hopefully, for right now. All right, guys. Thanks for holding on. And if you had any other questions, anyone else raise their hand, just do that. All right, so we're going to start, all right, go back here. All right, close this. All right. So the main thing I want you guys to kind of understand with all of this stuff from a legal standpoint and why this works, because a lot of people have questions about, okay, how can this actually work, why it works, all that stuff. I don't want to get too much into the weeds and the nuances, but the main thing to kind of understand is the reason why these things work the way they do is because we're avoiding two things. Okay. Number one, we're avoiding constructive receipt, which, so going back to the whole thing with the 1031 exchanges, the way that 1031 exchanges have to work is you have to obviously choose a property, obviously sell your original property, but you can't take constructive receipt. You can't take hold of the possession of the funds. That money has to be go straight directly into what we call an escrow account through a qualified intermediary, and then straight to that property. So you can't actually touch that money. If you touch that money, if you have constructive receipt, then you're going to pay taxes. That's what's called a taxable event. And so if we want to avoid that, we have to avoid constructive receipt. And so it doesn't matter what tax structure we use, whether it's a trust or this or that, we're avoiding constructive receipt because the sales proceeds are going to be redirected to the corpus of that entity and not to your personal estate. And so that's how we legally avoid the tax, because the money is not going to you. Now, that being said, the second part of that is also important, which is self-dealing, meaning that for you to be able to do that in the first place, you cannot act as the owner. All right. So you have to relinquish ownership of that property personally. So the whole idea of self-dealing is, hey, if you're doing something, you're changing it, but you're masking it through an LLC, but you're the owner of the LLC 100% or whatever, then it's not, you're not really moving the needle. You're not really avoiding tax. You're just trying to, put money from one pocket to another. So we have to avoid self-dealing. And the way we do that from a legal standpoint is we have to have you as the owner relinquish ownership, but not control. So you're not going to act as an owner, but as an administrator, whether it be a fiduciary, a trustee, depending on how the tax structure is set up. There's different terms, but that's how we're able to legally do these things, is by taking away your ownership. And this goes to the whole concept of own nothing, control everything. And this was a term that's very much associated with John D. Rockefeller. If you're not familiar with who John D. Rockefeller is, just Google him. But the reason why he said this, and it's not just him, it's every wealthy person before him and after him, they understand that when you own something, right, when you have something in the ownership you bucket, right, in your personal estate, the more ownership you have, the more taxes you pay, right? And unfortunately, we live in a very litigious society. When you own something, what happens? People try to sue you and take money from you, try to take your assets. So when you're operating in your personal estate, in your U bucket, I call, more ownership, more taxes, less protection. But when you operate in a tax structure outside of your personal estate, where you own it less, it's less tax and more protection. So for a lot of people that are looking to grow their wealth, they start to understand how this works, and this makes more sense. Now, my whole philosophy is that in life, we don't really own anything. We're just stewards of what we have. But that's a whole other conversation that I won't talk about right now. But that's kind of how this works. And so to give you an idea of why this is so important when it comes to using these strategies, and I have a video that goes over this case study more in detail, but this is a realtor we were working out with a few years ago, I would say around 2020, I think it was, in California. The property initially was purchased for about $217,000 in the 80s in LA. They put about $2 million in improvements. So, pretty decent, but now the property is worth $30 million. It's crazy. It's LA, everything just, went through the roof. So when it was all said and done, this was the actual profit, was about 25,000, okay, which is pretty good. But they didn't realize, again, until they were right before closing, this was the actual taxable gain, about 27,000. So it wasn't just the capital gains. So the capital gains was just 20%, is 5.4. But when you add in California state tax, the net investment tax, depreciation recapture, and this was before the LA mansion tax. If they sold it after, they would have had that. But you're talking about almost $10.6 million, almost 40% in taxes they're paying, right? 40% of their profits were going to taxes. So it's just a kind of reminder to understand that if you're not being proactive, most people don't realize this stuff until it's too late. And you have to be proactive when it comes to these tax strategies. So at the end of the day, we were able to take the client, and there was some background that they actually lost the listing and they got it back. But this is what they were looking at. They were looking at, again, paying about 10.6 million in taxes and having this much left over. Now, don't get me wrong, that's still a lot of money, right? And I'm sure most of you guys would be okay with, making a, $16 million profit. But because we were able to put a tax structure in place, this is what ended up happening. They ended up having $27,000, and it's after the cost of the sale, obviously commissions, closing costs, all that stuff, and the tax structure. So the attorneys, the CPAs, all that stuff, putting that stuff together, it still made sense for them to do this.
27 million. They ended up having, not thousand. Yeah.
I'm sorry, I misspoke.
Yeah.
Sorry. It's Thursday, so you got to forgive me. So yeah, so it for people to kind of understand why this is important, you have to understand the tax impact before you do it. But again, most people don't understand taxes until it's too late. So let's go over some examples of these tax structures. And again, I don't want to take too much time, but I do want you guys to kind of understand how some of these things work. So the first one is what's called a structured sale agreement. Okay. Now, is anyone here familiar with an installment sale or owner financing deal? Or has anyone done one? Raise your hand. Sarah? Okay, good. So Sarah's done. So yeah. So if you're owner financing, you know, for some sellers is attractive from a tax standpoint because what? Because hey, I don't have to pay the whole capital gains tax at once. I can kind of spread that out over, you know, 5, 10, 15 years, whatever it is, right? But what's the downside of that? Sarah, since you've done one before, what's the downside of doing owner financing from the seller standpoint?
More risk. You don't get your money all at one time. Just having to deal with the people making the payments, it's kind of a headache.
Yeah, yeah. It's a huge risk for the seller. It's a huge risk. And that's why a lot of sellers, they'll look at it as a last resort kind of, versus something, you know, that they want to do. And then obviously you have the pool of buyers, right? Like she said, you don't want to take on that risk. So what kind of buyer do you think would be willing to take on that?
It's subprime, you know, so you're dealing with people who, you know, can't get financing. So I mean, you get more risk and you might get a higher interest rate. I mean, there was the best one that we ever got was like 11%. But you're also having to deal with someone that might not make the payments, and then if they don't, you got to do the repossession process and all of that.
Yep. And that's a taxable event too, which sucks. So yeah, so a lot of risks with traditional owner financing, or what we call installment sales, Section 453. There's various different ways to do that. This is one of many of them. And so what this allows you to do is to essentially take that, okay, instead of taking all the capital gains at one time, let's spread it out over a few years. But I don't have the risk of the buyer defaulting. So the way it works is the seller is going to transfer that property to what's called an assignment company, very similar to a 1031 exchange accommodator. Okay. And then that assignment company is going to receive all the sales proceeds from the buyer. So it's basically going to change from one hand to hand, but again, no self-dealing, because assignment company is a third-party company, not the seller. And the way that works is now the buyer has a property, and I'll show you how it works on the next slide visually, so it makes more sense. And then the assignment company is going to ensure those structured payments, and the seller could even choose lump sum, so they can say, hey, I want, you know, first year I get, you know, $1 million, second year, or maybe I only get 50,000 a year, whatever. So they can structure those payments through an annuity. So it takes the risk off because it's coming through an insurance company. So it's just like getting bonded. So the seller is able to reduce not only capital gains, but state tax and investment tax by receiving that income over a series of years, but again, without the risk of the buyer defaulting. And when you structure these things the right way, with the interest that they're going to earn from those annuity payments, the seller actually gets back more than their initial sales price. So when we work with real estate brokers and sellers, specifically with a lot of like higher end commercial properties and stuff like that, they may see, hey, the market, it's not moving right now. It's, you know, you want this, but we know if you to get this, it might take you a year, it might take you 2 years, and you probably don't have that much time. So let's sell at this amount, which is lower. So yeah, you're going to take a haircut, but because of the payments that you're going to be getting over time and the taxes that you're going to be saving, you're actually going to be getting more over time. And so this is one of the strategies that we use to show sellers how they can lower the listing price and actually get more over time. So the way it works,
Stefan,
again, just
Stefan, I just wanted to
yeah.
interject. So just for the realtors that are on the call, if you're dealing with commercial properties and you are up for a listing and your seller says, why should I hire you? That's a very powerful strategy. If you can say to them, well, listen, I can show you how you can, you know, sell it for less, get more, and sell it quicker. So that's very powerful, especially with all this NAR stuff coming up and all the competitiveness. To get those listings, that's a good strategy that you have in your back pocket.
Oh yeah, for sure. And on top of that, it really is the whole concept of understanding that you're obviously trying to work in the seller's best interest, and their best interest is obviously keeping as much money as possible. And time and taxes are the biggest profit killers for you and your clients, right? The longer if you're in the business of real estate, the longer it takes you to sell that property, the more you risk losing the listing, right? So this is something that's really going to help in that endeavor. But just to go back to the illustration real quick. So again, the seller exchanges the property. They're going to do an installment agreement just like they would normally with a normal owner financing agreement, but the buyer is not going to be doing those installment payments. The assignment company is going to be doing that. So the assignment company changes hands, property goes to the buyer, assignment company gets the money, and then they send all the structured payments to the seller. Okay. So that's kind of how this strategy works. Any questions about this? No? All right. So we will go into another strategy real quick, and this is the family trust. Now, has anyone heard of or used or sold a property or maybe even had a property in their own family through a trust? I know Sarah talked about that. Anyone else? Nobody? Okay. Well, trusts have been around for a very long time, so this is really nothing new. It's been around for, hundreds of years. And the way these family trusts are set up is that these are, if you've heard of a trust fund baby before, the chances are they're doing things through a family trust. So these are essentially generational tax structures that defer the taxes indefinitely. So if you like tax deferral, within the case of a 1031, this is a 1031 on steroids because it allows you to defer the taxes for generations, essentially. And it's used a lot by, again, the wealthy elite. And the way this works is that you're essentially operating through the auspices of the trust and not, again, through your personal estate. So when you're selling properties, the trust itself is going to sell that property, and then those sales proceeds are going to go back into the trust. Okay. But because that trust is a non-taxable entity, it's what's called an irrevocable trust structure or an ongoing trust structure. It's another term for it. There are no capital gains tax due because there's no distributions required. The other part of this, which is really cool, is that the trustee, so your client who's a seller, okay, or yourself, if you have your own properties, you can actually reside in and utilize a trust asset. So you can go purchase a property, right? Put it inside the trust, not pay capital gains tax, and actually live in it. Pay yourself, pay a lease through it or whatnot. You have cars, you can put those vehicles in the trust and drive the trust vehicle. So it allows you to actually use the assets inside of the trust, which don't typically happen with your ordinary, living trust or revocable trust or grantor trust. So these type of, family trust, dynasty trusts, another term for them, are very versatile because it allows you to run a lot of your typical personal expenses as trust expenses, as long as it's operated the right way. So again, when you're using these tax structures, it is a completely different ball game. Okay, you have to be doing things the legal way. So there's going to be tax reporting. You're going to have to do a tax return every year. You have to do bookkeeping. The books have to be kept right. There's separate bank accounts, all that stuff. But it allows you to do things much more efficiently from a tax standpoint. On top of that, not just capital gains, you do this with other types of income. So rental properties, you have rental properties, put your rental properties in the trust, boom, now all that rental income, not taxable. Same thing for dividends. You invest in stocks or crypto. A lot of people do crypto. This is a great way. This strategy in itself is a great way to, if you have crypto and you bought it, way back when, and now it's gone through the roof, you want to go buy real estate with your crypto, boom, you can do it through the trust. K1s, even commissions, you can put in through this trust and defer those taxes indefinitely. And so what that does, it allows you to, obviously, since you're not paying all those taxes, now you can grow your wealth a lot more efficiently, right? And me and Shelly were talking recently about, in North Carolina, that's where we are. There's a lot of real estate rentals on the beach, on the coast, in the Outer Banks and other parts, that they're getting killed with their insurance rates now, because of all the hurricanes and different claims that they've had, the past few years. All the insurance companies are either leaving or they're jacking up their rates. So they're getting cut off at the knees with their cap rates, with their, net operating income, what they're actually able to take in, because their insurance went through the roof. Well, if you can take taxes off the table, this, you don't have to worry about, the insurance cost rising so much. So there's all these different cool things that are valuable when you're using these tax structures. And the last thing, which is the most important thing, is the asset protection. Because when you're using these structures, again, it's the whole own nothing, control everything. So you're going to be able to have, be able to make executive decisions and management decisions and changes and buy assets and stuff like that, but you're not going to own anything. So what that means is if someone tries to sue you or whatever, okay, anyone can sue anybody. It's just whether they're going to be able to get to it or not. And if it's inside the trust, they're not going to be able to get to it because you're just the trustee and not the owner of those assets. So that's kind of how this strategy works. I could go a little bit more in detail.
Stefan, I just like to add
Yeah.
one of my favorite things about that structure, if you don't mind, which I think is pretty amazing. So right now, like if you own your properties and everything's in your personal estate bucket, right? Everything, you have to earn your money, you pay tax on your money, and then you pay your utility bills, your mortgage, whatever, with your after-tax money. When you utilize this trust structure, excuse me, you're paying for all of your utilities, the pool man, the mortgage, the insurance for your home, everything on a pre-tax basis. So you're doing things much more efficiently. So if you like efficiency, this is definitely a great structure to be efficient with your assets.
Oh yeah, 100%. So yeah, so to kind of piggyback on that, going back to, number 3 here is, again, the trustee can reside and utilize trust assets. So what that means is, okay, if you put your primary residence, your personal primary home where you live, inside the trust, if you have a mortgage, now you can use the money inside the trust that you're earning from capital gains or from rents or dividends or whatever. You can use all that money that you're not getting killed with taxes on to pay for your mortgage, to pay for the insurance, to pay for the property taxes, the new roof, all of the expenses, like Michelle said, that you work, earn money, pay taxes, and then pay those things after taxes, even educational expenses. And I have another business that I do college tax planning, and we utilize this strategy a lot to help pay for college, because if you have kids, you can have those educational expenses be paid for by the trust 100% up to age 21. So there's a lot of really cool things involved in these structures.
And healthcare and your healthcare expenses. And if you have a parent that needs like nursing home care or something of that nature, some type of assisted living, you can name them as a trustee as well, or a beneficiary. You can get that paid for through the trust on a pre-tax basis. And those expenses are huge.
Exactly. And so, yeah, it just goes back to, okay, are we operating, going back to what I was talking about before, operating in the U bucket or in the tax structure bucket, right? So the whole point of all of these structures is to help you guys operate over here as much as possible. There's always going to be things that you need over here, right? You need, what we call food, fun, and fashion, right? You need some new Jordans. You want to go take a vacation, things like that. right? So you're going to always need some income in your personal estate to do things that you need to do. But there's a lot of things, and what we kind of analyze is look at, okay, what are some things that you could probably deem as personal, but let's see if we can get it run it through the tax structure legally. Let's do that. And so that just puts you in a much better position. So just to kind of illustrate how this works from a sales aspect of, okay, when you're actually selling a property, the way it would work is you, the seller, or the owner of that property, would transfer that property to the family trust at what's called book value or basis. So you're selling it over. So there's actual financial transaction happening, so to speak. So there's a bill of sale, there's a contract, purchase and sale agreement, deed, all that stuff that's done when you're selling that asset over to the family trust. Okay. And once that's done, once the property is in the family trust, then the family trust can sell it to the buyer. Okay. So you're really not changing anything except you're moving it from your personal estate to the trust estate. And then from that trust estate, you as or your client as the trustee is going to make that decision to sell that property to the buyer. And then all of those proceeds are going to go back into the family trust. And once they do, it can stay inside the family trust and no capital gains taxes are due, which is great. So, and again, now we can start taking that money, we can go use it to go buy more real estate or buy more crypto or invest in this or that, or pay for, kids' college or whatever. And then on top of that, again, now you can, put your primary residence in there with all that stuff and utilize trust assets. And again, any other type of income that you have, as long as it's passive income, we can kind of get that into the family trust. So that's kind of how it works from a 30,000-foot view. Any questions about this strategy? Nobody? You guys are real silent today. I know the CPAs are silent. They just like to watch me. But all right, so essentially, oh, Frank has his hand raised. Want to unmute Frank?
I'm trying to unmute Frank, but the mute button is not next to Frank's hand. So we're having another technical.
Okay. Can you talk now, Frank?
Okay, how
Okay.
about now?
There we go.
Yeah, so how is that different from a living trust?
So a living trust is what's called a revocable trust, which is basically you're gifting an asset over into that trust. So living trust is good because it's still going to help you avoid probate, right? But it's not going to give you any living benefits from a tax standpoint. So you don't get any tax benefits or asset protection in a living trust because it's for while you're living.
Plus, you're the grantor of a living trust.
Yeah.
And
most times you are, yeah.
You want to go over that? Why that would?
I don't want to get too in the
Okay.
weeds. It would take us another 30 minutes. But yeah, that's the main difference is with a living trust, it's made, those trusts are designed to make sure that while you're living, if something happens, all of your assets can pass to your beneficiaries without going through probate, which is a pain in the butt. But that's the only living benefit that you get. You don't get any tax benefits, and you surely don't get any asset protection because that is essentially still part of your personal estate. The only time it becomes outside of your personal estate is when you pass away. So it's great when the name is it kind of throws you off because you think living. So it's great. It doesn't give you any living benefits, essentially. So hopefully that answers your question, but
Yeah, sort of. So if we have properties in a living trust now,
mhm.
we want to transfer them into a family trust?
Yeah, if you were going to set up this tax structure, if it worked for you, whatever, you liked it, then yeah, you would revoke it back into your personal estate and then sell it to the family trust.
Is there a tax consequence upon that sale?
No, because again, we're not doing it at a gain. So again, just to kind of go back to this, when you are selling everything over to the trust, you're doing it at your cost basis or your book value. Okay, so you're not creating a gain because you already paid taxes
Okay.
on it, right?
Got it, yeah.
So that's how that works. And essentially, and I didn't go too much into detail just for the purpose of this call, what that does for you, Frank, is it actually gives you what's called a note payable or demand note that you can take out of the trust tax free. So let's say that book value is $500,000, right? You can actually take $500,000 out of the trust for food, fun, and fashion, for those things that are not typically trust expenses. If you wanted to go to, Hawaii on a vacation, you can do that because you're taking from the demand note, basically the note payable when you first sold the property over to the trust.
Okay. So
Okay.
does that family trust, is that ongoing, if my wife and I both pass, does that trust remain in full force to our heirs, or how does that work?
Exactly. So yeah, and so again, going back to that is that these things are designed to be generational. That's why they're called family trust. And the Kennedys, the Rockefellers, the Bushes, they have these things. They've had them for decades, because the whole idea with the typical like living trust, for example, the trust itself is going to, sometimes it'll expire. You could still renew it. But what'll happen is those proceeds, they're gonna the beneficiary is going to take a distribution from the trust. They're going to distribute it. Trust is going to be gone. They'll have the money. They're going to pay tax on that, right? They're not going to have to go through probate, but that's it. These trusts are set up to have those beneficiaries when you pass away. Instead of them taking a distribution, they can become the new trustees, right? And then just keep the trust growing and growing and growing and growing for generations. And so that's why these, the wealthy people use these structures, but you don't have to be a multi-gazillionaire. I mean, that's really our whole focus when we, talk to people is letting people know, hey, and I didn't know this years ago when I started in this business, that you don't have to be a multi-gazillionaire to use these strategies.
Got it. Thank you.
So these trusts renew
problem.
every 21 years. So you renew it with a stroke of a pen every 21 years. And your beneficiaries can become the trustees. They can also have their own trust be the beneficiary of this trust. But like Stefan said, we don't want to go into the weeds with any particular strategy right now. But yeah.
And these are just two strategies.
But they do offer living benefits when a living trust doesn't. It's really a bad, it should be a death trust. The living trust, change the name.
Okay, thank you.
No problem. Thank you. Good question though. So so just to kind of wrap up, the advantage if you're an investor, if you have if you're using these tax structures, is that you're not only going to be able to just defer, but reduce and even eliminate some of the capital gains, depending on the strategy that you're using. And you can do it for any property. So you're not restricted. Hey, it has to be, like Sarah said, like kind. It has to be this type of property. It could be commercial to residential to multifamily to whatever. You're just selling your assets. You're keeping everything within the auspices of that tax structure. You don't have to worry about identification deadlines or exchange deadlines, and that really kills the deal when it comes to 1031s. Most of the time is, hey, we can't find the property that we want, or we can't find the right cap rate for what we want within that time frame, or it just doesn't close for whatever reason. So you don't have to worry about the stress, which I would say is the biggest issue with 1031s, is the stress of having to go through an exchange for the most part. If you want to stay in real estate, and here, what I want people to kind of understand is that we don't have a dog in the fight. 1031s aren't horrible, but they're just not the only strategy. And so our whole thing is letting you know, hey, there's other options besides that when it comes to your real estate. And most importantly, it gives you more options, more control, more asset protection, which is huge in this day and age with all this litigious stuff with the NAR, everyone's lawyers, want to make money. It's like the wild, wild west. And asset privacy. When you start using these tax structures, it's not like an LLC or anything like that where people can, look on the Secretary of State's website. These things are not part of public record. These are all private transactions. And that's why wealthy people use these things. So if you're someone who likes and appreciates anonymity, this is invaluable. And as a real estate agent, for all of you guys that are real estate professionals, when you start talking to your clients and engaging your clients about these alternative strategies, it really is going to help you differentiate yourself.
Hey, real quick,
Yeah.
I'm probably gonna buy the.
Oh, okay. He muted himself. Sorry. Okay. So it really is going to help you, differentiate yourself, become more valuable and grow your business because you're going to be talking about things that other brokers aren't talking about. Again, like Shelly said, hey, when the seller, the first thing that's going to happen with this whole NAR thing is the seller is going to ask you, okay, why should I hire you? Right? Why should I give you the listing? Right? So when you can come to them and say, hey, I have tools, I have resources that can help you keep more money, take taxes off the table. We don't have to, force you into this or that. You'll have more options. That's a game changer. That puts
And-
you in a much different light.
And you don't have to do it. We're your back office. We're your support. So you have a team behind you. So
Yeah.
when they ask you that question, you're not only hiring me, you're getting access to my team, that can implement and,
Yeah.
bring these tax structures to the table for you.
For sure. And on to that point, I want to stress here that, with especially in real estate, if real estate professionals, there's so much, litigious stuff going on. You don't want to be put in a legal predicament for giving tax advice. So our goal isn't to show you how to give tax advice because you're not giving tax advice. You're just making an introduction into a strategy, just like you would with a 1031 exchange or a DST or any other type of owner financing, right? This is just another option. So we don't want to get you in trouble, or anything like that. We want to be kind of your support for that. And that's kind of what we do.
That's right. You're just making your client aware of another option, a concept. That's
Exactly.
it. And with
Frank,
us as well, when you work with a team of support, you get access to our back office of tax attorneys, CPAs, enrolled agents too, to help with, set up and implement these structures and strategies.
I think Frank had Frank.
Yeah, I'm back.
Yeah.
Does this work with the 401k contributions that have been, that we have?
So and that's what I'm going over right now. So if you're using a tax structure, you don't need a 401k or an IRA. It can really take that whole thing away because you can do all of your investments and everything inside of that tax structure. So when you're using these strategies, you don't need to do a 401k contribution or anything like that. You have to pay yourself a W-2 wage to be able to contribute into that. So if you're paying less taxes, then it doesn't make sense. So you can do all the things that you would and even more because, one of the things about self-directed accounts is there's lots of issues with self-dealing and stuff like that. If you're going to do an Airbnb or whatever, if you're operating within a tax structure, you can do whatever the heck you want, any type of business, investments, whatever you want, oil and gas, Bitcoin, you can do all that inside the tax structure. So it takes away the need to having to, hey, I need to buy another vehicle or buy more equipment, hire my kids, depreciation, using all of these tax tactics, I call them, which aren't bad. Again, different strokes for different folks. Some people may need these things, but when you're using a tax structure, it really takes all those things off the table. You don't really need it. So, and again,
any existing 401k plans that you have in place and monies could be transferred into the family trust without a tax consequence?
no, you can't do that. You can't do that because that's active income.
Okay.
So you'd have to cash that out, unfortunately, pay taxes on it. Now, there's other strategies we can talk about at another time to reduce the tax hit on those 401k distributions, but you can't take it from the 401k into the trust. No.
Okay, got it. Thank you.
No, good question. So at the end of the day, these strategies, doesn't matter what type of income you have, capital gains, short-term, long-term, you're flipping properties, you do buy and holds, rental income, dividends, royalties, commissions, K1s. We can, again, put you in a different position. It's a different way of doing things. So I want people to kind of really be aware that, okay, you're going to have to make some changes because all these different write-offs and things that you're doing, you're not going to need that as much because you're doing it within this tax structure, but we can make it happen on any of these types of income. So at the end of the day, it boils down to, okay, you got to like it. It has to, be something that works for you, but it has to make sense at the end of the day. And we've kind of, scratched the surface a little bit when it comes to some of these tax structures. And there's lots of different ones. I don't want to go into the weeds, but overwhelmingly, when it comes to cost and whether this makes sense or not, it really boils down to when it comes to your ordinary income. So 1099, interest, K1s, all that stuff. If you have 200 or more of that, then it definitely makes sense to do a tax structure. Anything less than that, probably not so much. Okay. Then, okay, do your 401k contributions, hire your kids, do depreciation, whatever you have to do, then it makes sense. But if you're 200 and up of ordinary income, so again, all the income that you're earning from work or self-employment or from your LLC or whatever, that's that. When it comes to capital gains, so I'm selling a property, or I'm selling a business, or I'm selling an asset, if that gain is 500 or more, then it definitely makes sense mathematically to set these things up. Okay. So just wanted to make sure you guys understood that up front of, okay, is this for me? Is this not for me? Is this going to make sense from a financial standpoint? If your numbers are more than this, then it's going to make sense to set up a tax structure. If it's less, probably not so much. Maybe there's some other strategies we can talk about, but that's that. So that being said, if you guys have any questions, and I'll kind of open it up for Q&A for everyone. We'll just open, Shelly, if you won't mind, I guess, unmuting everybody. If you have any questions, you can always email either me or Michelle, or call or text, and we'll set something up, send an appointment, kind of go over everything in detail, see what works, go over cost, and
I think
take it from
everyone
there.
has to, Stefan, I think everyone has to raise their hands for me to be able to unmute them. Because when I click on their name, the only two people I'm able to unmute right now are Frank and Sarah.
Okay. All
Um,
right, hold on one second. All right, I'm gonna unmute everyone, and then we'll just go round robin. And I see what was happening. It's on my side. So if you have any questions now, you can just unmute and ask your questions.
Stefan, it's Kalinka. Do you
Hey,
hear,
Kalinka.
do you hear me?
Yes, I can hear you. Can you hear me?
Yes, my question is very simple. You mentioned about 25 minutes ago that educational expenses for people under 21 could probably come from a trust, but that has to be a family trust. Is that correct?
Yeah. So it all boils down to what's considered a trust expense. And the way that these trusts are structured is educational expenses for beneficiaries. So typically the way that we use this from a college standpoint is you set up the trust, mom and dad would set up the trust, the kids would be the beneficiaries in that trust. Then any money that's inside the trust can be used to pay for educational expenses up until age 21. So yes, that's a trust. That would be a trust expense. So all that income that you're earning from your business or your capital gains or your rental or whatever, boom, now it's in the trust. Again, yeah, you can go and reinvest or whatever. Or, okay, we have a college expense. Instead of us working, paying taxes, paying ourselves a W-2 wage, and then paying taxes on it, then paying college, which is ridiculously expensive, we can just have the trust pay for it on a pre-tax basis, which makes a heck of a lot more sense.
So I do have a living trust, so it means that I have to make it a family trust.
Yeah, that would not work in a living trust, because the living trust, again, that's designed to, it could pay for college. If you pass away, right, all that money goes to your beneficiaries without probate. They don't have to go through courts or anything. And then they can use that to pay for whatever. Now you can determine in your trust documents, hey, I want to give X amount once they graduate or this or that. But that's how it would work with the living trust, because that's how those things are set up. But with these trusts, it's an actual trust expense. So the money inside the trust is paying for it. With living trusts, there's typically nothing inside it except for assets, right? You have a property in there, you may have things like that. But this would actually have money from rental properties or other assets, vehicles, stuff like that. So it's literally its own entity. Again, files its own tax return, has its own bank account, does its own bookkeeping. And that's how it would be reconciled with the books is, okay, this year we're going to use this for an educational expense for our beneficiary.
Got it. Thank you so much.
Yeah, no problem. Anyone else? Floor is yours, guys. I'm here to answer questions. Bill?
Hey, Stefan.
Hey.
Stefan, this is Phil. Real quickly, can you put up the contact information again? I didn't quite get it.
Yeah. Here.
Thank you.
No problem.
And just a quick follow-up question, Stefan. I'll make it quick.
Yeah.
You know, I'm a CPA. Love to work with you guys and see how you might be able to assist some of my clients.
Oh, for sure. For sure. Yeah. Yeah, definitely.
Do you guys have any kind of program where you have alliances with other professionals?
We work with a lot of tax firms all over the country, and the way our symbiotic relationship would work with the tax firms really is obviously helping you give value, help your clients save money in taxes, but really from the bookkeeping standpoint, because again, the trust is its own entity. So if you do bookkeeping, there's going to be bookkeeping that needs to get done, the whole chart of accounts, and it has to get done the right way. So that's, that could be another revenue stream for you. So there's lots of different ways, but yeah, we love working with open-minded CPAs and accountants that, want to, do things differently. So yeah.
Okay, I appreciate it. Thank you, Stefan.
Oh, no problem. Thank you.
Hey, Stefan, where are you guys located?
We're in North Carolina. We're in Pinehurst, North Carolina, about an hour south of the Raleigh-Durham area.
Okay.
Have you ever heard of it? Y'all like golf? We're a huge golfing
Yeah, we got the US Open. We got the US Open coming in
2024, in June.
Which is funny because there's anyone here that likes golf, have you heard of the British Open? Anyone heard of the British Open in England? Well, just look it up. It's called St. Andrews, right?
Yes.
It's actually called the St. Andrews Links Trust. It's run by a trust. It's been run by a trust for generations. So again, this stuff isn't new, but most people don't know about it. But yeah.
And again, also all of the strategies that we have introduced you to, they're not statutory strategies. So it's on a federal basis. So we can work in any state. These strategies work in any state. And most of our clients are from all over the country. We have a lot of clients from California with, the exorbitant taxes there.
Yeah, they're moving
all
here.
over the state. All over the state, we have clients.
They're moving here in droves. But all right. Any other questions?
Never mind.
All right. Well, hopefully you guys enjoyed it. Again, our contact information is here. I'll be sending everyone that was on the call, minus the CPAs and Ronald and a few guys on the call that already know us. Send you a reminder email with our contact information. But yeah, if you have any questions, you want to set something up, just reach out and we'll take it from there.
Very good, Stefan. Thank you very much.
All right.
Informative.
No problem.
All right, thank you guys. Thank you.
All right. Have a good one. Bye.